going back to the year 2000. Going into it, your equity market looks a little something like this, up 0.4% on the S&P 500. On the NASDAQ, we're doing okay, up 0.4% also. In the bond market, yields have been surging higher, much higher going into this one. Your two-year yield shaping up as follows. Yields at the highs of the year. With your Fed decision, here's Mike McKee.
Well, no surprise, the Fed raises interest rates by 0.5 percentage point, 50 basis points, to a range between 75 and 100. They also outline the parameters of balance sheet reduction, which will begin next month, and promise more rate hikes to come. In their statement, the policymakers characterize inflation as elevated, reflecting supply and demand imbalances related to the pandemic, higher energy prices, and broader price pressures. Russia's invasion of Ukraine has unknown implications for the U.S. economy, they say, and related events are creating additional upward pressure on inflation, likely to weigh on economic activity. In addition, COVID-related lockdowns in China are likely to exacerbate supply chain disruptions. The committee is highly attentive to inflation risks. And so the decision to raise rates by 0.5 percentage point for the first time since May of 2000, they say they anticipate that ongoing increases in the target range will be appropriate. They add the committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The decision unanimous this time. As for the balance sheet, the Fed says it will start letting Treasury and mortgage-backed securities roll off mature starting on June 1st. They will cap the amount that can roll off in any 1 month at $47.5 billion initially, 30 in treasuries, 17.5 in mortgages. Those will increase over 3 months to 60 and 35 for a total of $95 billion. That's the figure that had been given in the minutes of the last meeting. Back to the language they used after stopping post-financial crisis QT. They say they intend to slow and then stop the decline in the size of the balance sheet when reserve balances are somewhat above the level it judges to be consistent with ample reserves. Guys?
Mike McKee, let's whip through this price action. Equities with a little bit of a lift here, up 0.7% on the S&P. On the NASDAQ, up 6 or 0.7% also. A curious move in the bond market initially, had a bit of a rally, yields lower at the front end, started to price out just a little bit from the June meeting. Mike McKee, then we come back again. Two-year yield unchanged at 278, still in and around the highs of the year. Has anything changed from what we've heard so far, Mike, that would lead you to change your question that you had prepared for Chairman Powell in 30 minutes?
I'm sorry, John, did you ask me?
I did, Mike. Is there anything new in this relative to what we expected coming into it all?
No, and the interesting thing is, I almost started off by saying you priced it in, they delivered. The Fed gave the market what it was expecting. And we were talking earlier on your show about how the Fed is sort of front-running itself. It's telling the markets what it wants them to do. And at this point, they seem satisfied with the markets adjusting to a regular rise of about 50 basis points. No suggestion in this statement of 75.
Michael McKee, we were talking with Dr. Ferroli over at J.P. Morgan about the two parts of the American economy, the domestic part and export-import, even the inventory build that's being discussed. That trade balance number today was a wow statistic. How apart is this economy that Chairman Powell faces, domestic and trade?
Well, a lot of it is trade because of the backups that we've had, Tom. All those ships off the coast that were holding goods and couldn't land in December, in January, have finally started to come ashore. We're getting all of those imports. Plus, the economy here is strong and people have been buying. And we buy a lot of things from overseas. The general feeling at the Fed is that those numbers are going to start to correct. We'll start to see the trade balance fall. But it is bad news in the short run. And they acknowledge that the economy has been weak in the first quarter.
Meanwhile, the FOMC did repeat their comment that with appropriate firming in the stance of monetary policy, the committee expects inflation to return to its 2% objective and the labor market to remain strong. Objectives that some people would say are at odds with one another at a time where it's very hard to see another way for inflation to slow without dampening demand. What kinds of changes are you expecting to hear around the edges to one or the other in order to understand the prioritization of the Fed right now between inflation and their labor market mandate?
Well, it's going to be interesting to see if the chairman at least has changed his view, or if he speaks to the committee in changing their view of where they think inflation is going to be, particularly by the end of this year, if they are going to be more aggressive in raising rates. We don't get official forecasts this time. So do they raise their estimate to match what the market sort of sees happening? The other aspect of it is that when you go to economics school, they teach you if you're making a forecast, give a number or a time frame, but don't give both. So yes, they expect inflation to go back to 2%, but they're not saying by when. The answer on the unemployment side is the Fed has been very confident that with 11.5 million jobs out there, they don't have a big risk of sending unemployment up a lot in the short run. Over a longer term, perhaps, but right now, they feel if you lose your job, you can probably get another one.
Mike McKee, wonderful coverage as always from you, sir. Looking forward to your question in the news conference a little bit later this afternoon. Just to run through the decision, we get a 50 basis point hike. You were all looking for it. The first one going all the way back to the year 2000. Plans to wind down the balance sheet. That will begin in June at a monthly pace of $47.5 billion. That will step up over the next 3 months to $95 billion. Worth pointing out, that is twice the pace, double the pace basically, once they get to 95 billion than the pace we were running at last time around when balance sheet runoff started. When was that, Bramo? 2017, 2019? It's quicker, much quicker.
Faster. They've got a lot further to go. And a lot of people take a look at the labor market, they see a lot more momentum. I do want to go back, though, to this idea, this dueling objective. They're talking about getting inflation down. What is the time frame, as Mike was saying, to get back to 2%? Is it okay if it happens in 2035?
I think ultimately right now, they don't have to choose between growth and inflation. They can focus on inflation because the data is good. We heard that in the last news conference. I would have expected to hear that again in this news conference too. But this line in the statement I think is pretty interesting. The committee is highly attentive to inflation risks. Then he talks about China. I say he, not just the chairman, but the whole of the Federal Reserve. The issues there are likely to exacerbate supply chain disruptions. Then on top of what's happening in Russia and Ukraine, that's likely to create additional upward pressure on inflation. Okay. But also likely to weigh on economic activity. Now, this is the dilemma that people think the Fed might face towards year-end, Tom, where they have to choose between supporting growth or containing inflation. And that's the dilemma that maybe a lot of people obviously don't want this Fed to have to face.
I'm not gonna overthink that, John. I'm gonna look at the partition here. Given the supply shock you talk about and the continued shocks, the China lockdown, or the separation of domestic and foreign economics for America. Someone to partition that for us and to expect the unexpected is Scott Miner, Guggenheim Global CIO. Always controversial, always interesting, ready to take notes. Dodgers strong this morning. For those of you on radio, Mr. Miner, very much LA Dodgers right now. Scott Miner, I'm going to cut to the chase. We have to expect the unexpected, and that always speaks through the bond fixed income system. What will the price of bills, notes, and bonds do?
Well, I think right now, Tom, we're actually coming to near peak. When you see how much we've backed up, we're from where our models sit, we are now 5 standard deviations away from our predicted level for rates. That tells you that we're like 1 in 3.5 million probability of getting to this level. We're really overextended. And I think that the Fed, with its inflation fighting, statements here, that it's very, very hawkish. They're being very, very aggressive in terms of both shrinking the balance sheet and raising rates. That the market is going to have confidence that they're going to overcome the inflation problem. The real question in my mind is, going back to the 1930s, we have never been able to reduce inflation by more than 2.5 percentage points without inducing a recession. So even if we don't get close to the 2% target, it's very likely that we will have some kind of an economic slowdown well before we get to the desired inflation target.
When we see the trade balance today, that's the kind of shock that's almost exogenous to the zeitgeist out there. What items are you looking for, Scott, that feed into you this recession call? What are the things that matter to get to a true contraction?
Right. Well, Tom, it's interesting. Everything we talk about, and you'll appreciate this, we keep talking about the rate of change. And the rate of change is obviously the first derivative. But I don't hear people talking about the second derivative. And that is, what is the deceleration that's occurring in various parts of the economy? If we look at money supply, right now, on a year-over-year basis, we have M2 up above the inflation rate by about 5 percentage points in real terms. But when you look at it over the last 3 months, we actually are having real money contract by a rate of 3%. The second derivative is the thing that's going to tell us how quickly that we're going to get there. And I think the market is not focused on that, but I believe that somewhere here in the near term, we're going to get preoccupied with how quickly all these numbers are changing.
Scott, let's talk about what it means for this market. You've seen the story in the Financial Times. The bond bull market has come to an end. Guggenheim, Scott Minard says, I know your view is so much more nuanced than that, from a tactical perspective and from a longer time frame going forward strategically. Can you walk me through how nuanced your view actually is?
Sure. Well, as I mentioned, using a cyclical adjustment for bond yields, we are now, well away from any outcome we would expect if the long-term bull market were still intact. But having said that, right, even when these long trends end, this 40-year bull market ends. We saw this when rates rose in the 60s and 70s. What happens is we tend to find we break the trend, but we then do a mean reversion and we go back down in yields. So I'm expecting that rates here are not going to go skyrocketing off into the stratosphere, but what we've done is by breaking the long-term trend, we now are probably in a protracted period, maybe 5 to 10 years, where the range on interest rates is going to be somewhere between the lows that we've had already and the highs that we're currently seeing. And that at some point, like in the 1940s and the 50s, that we will break out of that consolidation range and we will begin a generational bear market in bonds. One interesting thing to remember from the 1940s, we didn't break 2.25% on the 10-year note, which had been the high for the previous decade, until 1952. Once we started with an increase in interest rates, it took us 10 years to get to 3.25. So, when I say the long-term bull market is over, and I think it's very clear statistically when you're talking about probabilities of over 1 in a million that you're still in a trend, that doesn't mean that we're instantly reversing course and going to go rocketing higher. What it's telling us is we're probably going to go into a long period of consolidation and ultimately find ourselves somewhere in the next 5 to 10 years in a sustained bear market in bonds, which is further out in the investment horizon than most investors I know.
So, Scott, allow me to jump in. Before we jump to the next leg then, if you took that FT headline, you'd assume that Scott was saying dump bonds. You're not saying that. So can you tell us more specifically what role bonds have in the portfolio,
Sure.
given what we've just heard from the Fed and what we're expecting from the Fed further down the road?
Right. Well, Jonathan, I think based on everything we heard from the Fed, inflation fighting is number one priority. That gives me a lot of confidence that given how extremely oversold we are, that we're going to see a near-term rally in bonds somewhere. It's not necessarily starting today. It's not starting next week or next month, but it's not far out. And so I would expect that we're going to see a reversion back to the mean, that bonds will ultimately perform better again. And honestly, for people who are income-oriented, where today you can buy corporate bonds that are yielding 4 to 5% for high-quality corporate bonds, those are attractive income yields relative to where we've been. And there's a lot of money out there that would like to get higher income, whether it's in pension funds or insurance companies or just people in their IRAs. So, I think that near term, I'm actually fairly bullish. I think rates will come back down. We shouldn't be panicked. The Fed has been very clear. We're going to fight inflation. We're not worrying about the economy right now. So inflation fighting is priority number one. And that's the sort of environment where bonds perform well.
Scott, you've been in the Milken Conference for a while. Do you think that people generally are too bearish or too bullish in terms of their investment theses, let alone just what they're saying, their prognostications about the longer or even medium-term outlook?
Well, it's really interesting, Lisa. Everybody seems to be so uncertain about the near-term future. But the longer-term view seems to be somewhat positive, if not bullish. I had a breakfast this morning with a major investor in private equity, and he was telling me he thinks, we're going to have a tough go for the next 8 months or so in stocks, but ultimately we're going to come out of this and do well. I'm always skeptical of the consensus views. The view today is so bearish on stocks, so bearish on bonds.
Right.
Every time we get this far out of consensus, it seems to be the opposite direction is the way to go.
Scott Miner with us on Bloomberg Radio and Bloomberg Television. John Farrell, Lisa Browitz, and myself, we welcome all of you to truly an historic day, to a 50 basis point move in the rate as expected. And John, if I look at the entire Bloomberg data screen, I guess I've got to just simply say equity's up. They like what they see.
Yeah, and then the news conference in about 15 minutes. If I can take it, Tom, a big question on the south side that many people have been looking for is the 75 basis point question from the Federal Reserve. A lot of people out there want to know. You're going to hear that in the news conference by at least one journalist. His thoughts on that, and within that answer, it's going to tell you a little something about the future.
Yeah, right. I don't think he's going to get out front on 75 beeps, but he may talk about the calendar items going to the end of the year. Diane Swak is focused on the end of the year with Grant Thornton, their chief economist, and we're thrilled she could join us today. Diane Swak, I want you to look out, as Michael Feroli of JP Morgan did a moment ago, at the two-part economy that Chairman Powell faces. A buoyant, fully employed domestic economy, maybe with a negative statistic, off of the international dynamics, export, import, inventory, build. Does he have to coalesce those two together, or does he ignore the trade balance and say, I'm focused on a good American economy?
I think he's going to ignore the trade balance. I think the biggest issue here is he's focused on inflation, and he's going to be more Volcker-esque in terms of inflation. This is a Fed that, many of the leadership have now said, a little hard to get to that magical soft landing. And you're hearing more within the Fed admit that is a word that Chairman Powell himself used, softish on the landing.
Softish.
That's harder. And our own analysis, softish. He actually used that word, soft or softish. And I think that's really important because our analysis suggests we need to get above 5% on the unemployment rate to derail the inflation that we've got out there right now. We've got 1.9 job openings per worker. That is up from a little above 1-to-1 back in February 2020, which is what Powell wants to get back to. You've got to both hammer demand and increase supply of workers. The only way to do both is to
I don't mean to interrupt, but this is too important before this press conference. What is the carnage in economic growth to get us out to a 5% unemployment rate?
Well, it depends on how fast you want to get there. You can get there with a soft landing, with the economy stalling out on the domestic side in the second half of the year and into 2023. That's by the end of 2023, where growth is just not enough to hold on unemployment. Or you can get there more rapidly by actually having a contraction in growth. And that's where the uncertainties with the war in Ukraine, all of the other issues, the supply chain issues we face, really hard. The Fed's decision today is that they've got to bring demand down to a supply-constrained global economy. And the only place they can increase supply actually is in the labor market. And I think that's a really important issue that gets lost in translation. It's that this is a Fed hammering demand, and we can do it with a soft growth recession, a mild recession that's more prolonged, or more aggressively, but it's the non-linearities. It's the unanticipated effects as rates spike more rapidly. One of the things we do know is that mortgage rates that go up don't necessarily hammer the housing market and home values. Mortgage rates that go up rapidly, like we've seen, are nonlinear and have a much more dramatic effect on both of those things.
Diane, another way of illustrating the tough job the Fed has is just going through their forecast. The last time we were all together, we had the summary of economic projections from the March meeting. The forecast looked like this. PCE 4.1% for 22, 23 it comes down to 2.6, 24 down to 2.3. And the curious part of the forecast was the fact the unemployment rate was at 3.5 for this year, 3.5 for next year, and 3.6 for the year after that. Dan, everything you've said, do you still think it is incredibly unlikely that they can get inflation down to 4, down to 2, and keep unemployment exactly where it is at 3.5%?
Well, I never did, so I still don't. I think I called those forecasts fanciful at best when they first came out, and they just don't count. They just don't add up, and that's the reality we face. And you're now starting to hear that from within the ranks of the Federal Reserve, talking about a harder landing, talking about how hard it is to get to this. You know, former Fed Vice Chair coming out, Don Cohn, and saying, you know, the probability of them being able to do this all right, 25%. That's a 75% probability that they slip into a recession. In his assessment, I think this is really important, is the Fed is now in a position where they're focused on inflation and employment is secondary. That is a very different equation than we've seen the Fed in for a very, very long time.
Does it remain that way? That, I think, is the more important question, isn't it? Because you can say those things right now as a Fed official because unemployment is at 3.5%. But when it starts to go the other way, when you start to see demand get hit, will you remain committed to inflation if it's still at 4 or 5? I guess the easier way of asking this question, we've asked it through today, through the morning and into the afternoon. If they have to choose between supporting growth and curtailing inflation, do we know, Diane, what they'll choose?
They'll choose containing inflation. I have no doubt of that. And that may come because of the nonlinearities that we see, or it may come because they raise rates. Either way, we're going to get inflation down, and that is their goal. It's a global inflation problem we face. And I want to get to another point that Scott had made about the next phase. After they get through this inflation phase, we're going into a world that's likely to be more inflation prone with a more activist Fed for some time to come. We're going to be more vulnerable to boom bust cycles as we move from just in time to just in case inventories, more regionalized supply chains, more higher cost onshoring, all of that with harder borders. That all suggests a world in which we're more inflation prone than we were the one we left. And I think it's really telling that those at the Fed do not see us returning to the world we left in 2019. Even Jay Powell in March at our NABE meeting, he said, no one is sitting around and waiting for the world that we were in to come back anytime soon.
That said, they're still looking for that 2% inflation rate. They reiterated that in their statement. And Tom Porcelli over at RBC had this to say. He said he wants to understand whether Powell wants to get that 2% inflation target before he stops raising rates, because if he does, then funds will be meaningfully higher than what most folks seem to think at the moment, and recession will be upon us. Do you think, Diane, that he wants to see, that Jay Powell wants to see 2% inflation before he stops raising rates?
I do. And I think that's because of the environment we're in. We do have some things that are an offset. A strong dollar is not the situation we had in the 1970s when the dollar was depreciating, but we've got a global inflation environment, and central banks around the world has been slow on the uptake because of the pandemic, the 1-2 punch of the pandemic and the war in Ukraine, and then the Fed citing the lockdowns in China as well. I think they really are focused on how supply constrained this world is, but that they can't look through those supply constraints. They now have to deal with them. And I think that's the reality we're dealing with.
Initially, after this Fed decision came out, the reaction in markets was pretty quiet, things fluctuating around. Now they're decidedly lower on the equity side as people parse through. And I wonder, Diane, how much it has to do with exactly that point. The fact that the risk factor with China lockdowns, the risk factor even with the Ukraine war, was to higher inflation. And that was the emphasis more than slowing growth.
Exactly. And I think the reality is we're talking about also the risk of stagflation abroad, accelerating inflation even as they may contract in response to the war in Ukraine. That is an untenable situation and an unsustainable situation, and one in which the Fed as the central bank of the world has to take into account as well.
6 minutes to the press conference, and Scott Minerd with Diane Swag today. Just thrilled at this guest list, and we get a great conversation for it after the press conference. Michael McKee, of course, in attendance. Scott Minerd, you've been listening to this, and a 5% unemployment rate, or wherever it would head given economic contraction, speaks to the politics of this Fed. You and I have studied McChesney Martin, Truman. I believe it was McChesney Martin and LBJ again in Vietnam. How political does Powell have to be sensitive to the Washington process?
Well, I think, Tom, that they're demonstrating right now that they have to be highly sensitive. The uproar over price increases and the pressure they're feeling from Congress, I think, is causing the committee to be maybe more aggressive than they normally would be, because they want to demonstrate politically that they're being strong and they're fighting inflation. The thing that I find interesting, and I agree with Diane, I love the way she divides this up into a two-part issue, which is the first part is this inflation battle that we're currently in, and then there's this period that comes later. My biggest concern is that because of the political pressures, if the sentiment in Washington should flip and unemployment becomes a bigger concern than inflation, that the Fed would then find itself feeling that it had to pivot before it reached its 2% inflation target. And if it did that, that deeply concerns me about the credibility of the Fed in terms of being viewed as an inflation fighter. And it would probably bring forward my outlook longer term that we will eventually enter a bear market in bonds, because Diane is right in terms of we have a lot of structural problems here. We don't have enough workers. We have to rejigger supply chains. There are shortages. So structurally, our economy right now is not set up to allow the Fed to pivot early if they don't have inflation under control, if unemployment begins to rise and they start to feel political pressure coming from Congress.
Scott, embedded in that statement that you just made was a question about the credibility of this Federal Reserve. Are you saying that this chairman, Jay Powell, is sensitive to the political mood of Washington, D.C.?
Absolutely. And I'll tell you why, Jonathan. And that is that what Tom was alluding to was the pressure that Arthur Burns and people like that, who were chair of the Fed, felt having to deal with Lyndon Johnson and Nixon to continue to allow inflationary pressures to build to keep the economy moving. And so I believe that the Fed's independence is being more challenged today than it has been in generations. And the chair knows that, the committee knows that, and they are being more reactive to the political pressure than they might have been under a Volcker or a Greenspan or a Yellen era.
And Diane, does that resonate with you at all?
So I would do another little nuance on it. I think that, first of all, inflation affects 100% of people. And even though unemployment is absolutely horrific and extremely hard, it only affects a few percent of people. And so inflation is always a bigger political problem than unemployment initially. And I think initially is a very important word here. The Fed's credibility is already on the line because inflation has persisted longer at higher rates than they expected. And transitory in economics, maybe a few years, that's not transitory in anyone's wallets. So I think the Fed does have their credibility at stake. I think Scott's right. Their independence is being challenged. But I also think the political landscape is part of what the reality of what we always see with inflation. And that is 100% of Americans see inflation. Not 100% of Americans feel unemployment. Even if unemployment rises to 5%, you still get 95% employed. That's not good. But it's the reality of the politics of this. And I don't think the Fed stops when unemployment rises. And on that side of it, that is also the credibility of the Fed, and they have to go there to reestablish their credibility after falling behind the curve on inflation today.
Dan Swank of Grant Thornton, thank you, alongside Scott Minard at Guggenheim, on a day where the Federal Reserve hikes interest rates 50 basis points, the biggest move going all the way back to the year 2000. QT, balance sheet reduction, that's set to start in the next month. TK, some big moves still ahead for this Federal Reserve.
A big moves ahead for the Fed, and they have to frame it out, and this is going to be a delicate press conference. He's going to be tested here with some really tough questions, John. I mean, I look at the screen, markets maybe haven't moved all that much, but I would settle in for a press conference where there can be any kind of, statement and then that follow-up question, John, which maybe would really set to the next meeting.
I have to admit, I'm not used to seeing people in the room, Tom. Looking at the feed now for the Federal Reserve, waiting for Chairman Powell to walk through this door, Bramo. It's been quite a while since we've had the journalists there. It has been 2 years. That's how long it's been.
How much do you think some of the technical issues of the last press conference encouraged and expedited the in-person press conference this time around?
I think perhaps that had something to do with it.
Just saying.
Just a little bit, perhaps maybe. Although we don't know for sure. Mike McKee is in the room. He's going to get a question, I'm sure, at some point. Going into it then, your equity market up 0.6% on the S&P 500. On the NASDAQ, up around 0.15%. Some big moves out there in the bond market over the last couple of months. Today, just a bit of a bid at the front end. Yields coming in a couple of basis points on a 2-year. Let's call it 276. On a 10-year, in a basis point to 296. Chairman Powell into the room, stepping up to the lectern. Here he is.
Nice to see everyone in person. For the first time in a couple of years. Before I go into the details of today's meeting, I'd like to take this opportunity to speak directly to the American people. Inflation is much too high, and we understand the hardship it is causing, and we're moving expeditiously to bring it back down. We have both the tools we need and the resolve that it will take to restore people. Inflation is much too high, and we understand the hardship it is causing, and we're moving expeditiously to bring it back down. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by 0.5 percentage point and anticipates that ongoing increases in the target rate for the federal funds rate will be appropriate. In addition, we are beginning the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. After expanding at a robust 5.5% pace last year, overall economic activity edged down in the first quarter. Underlying momentum remains strong, however, as the decline largely reflected swings in inventories and net exports, two volatile categories whose movements last quarter likely carry little signal for future growth. Indeed, household spending and business fixed investment continue to expand briskly. The labor market has continued to strengthen and is extremely tight. Over the first 3 months of the year, employment rose by nearly 1.7 million jobs. In March, the unemployment rate hit a post-pandemic and near 5-decade low of 3.6%. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, and while labor force participation has increased somewhat, labor supply remains subdued. Employers are having difficulties filling job openings, and wages are rising at the fastest pace in many years. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices rose 6.6%. Excluding the volatile food and energy categories, core PCE prices rose 5.2%. Aggregate demand is strong, and bottlenecks and supply constraints are limiting how quickly production can respond. Disruptions to supply have been larger and longer lasting than anticipated, and price pressures have spread to a broader range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to further exacerbate supply chain disruptions as well. Russia's invasion of Ukraine is causing tremendous loss and hardship, and our thoughts and sympathies are with the people of Ukraine. Our job is to consider the implications for the U.S. economy, which remain highly uncertain. In addition to the effects on inflation, the invasion and related events are likely to restrain economic activity abroad and further disrupt supply chains, creating spillovers to the U.S. economy through trade and other channels. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to restoring price stability. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by 0.5 percentage point and stated that it anticipates that ongoing increases in the target range will be appropriate. We also decided to begin the process of reducing the size of our balance sheet, which will play an important role in firming the stance of monetary policy. We are on a path to move our policy rate expeditiously to more normal levels, assuming that economic and financial conditions evolve in line with expectations. There is a broad sense on the committee that additional 50 basis point increases should be on the table at the next couple of meetings. We'll make our decisions meeting by meeting as we learn from incoming data and the evolving outlook for the economy. And we will continue to communicate our thinking as clearly as possible. Our overarching focus is using our tools to bring inflation back down to our 2% goal. With regard to our balance sheet, we also issued our specific plans for reducing our securities holdings. Consistent with the principles we issued in January, we intend to significantly reduce the size of our balance sheet over time in a predictable manner by allowing the principal payments from our securities holdings to roll off the balance sheet up to monthly cap amounts. For Treasury securities, the cap will be $30 billion per month for 3 months and will then increase to $60 billion per month. The decline in holdings of Treasury securities under this monthly cap will include Treasury coupon securities, and to the extent that coupon securities are less than the monthly cap, Treasury bills. For agency mortgage-backed securities, the cap will be $17.5 billion per month for 3 months and will then increase to $35 billion per month. At the current level of mortgage rates, the actual pace of agency MBS runoff would likely be less than this monthly cap amount. Our balance sheet decisions are guided by our maximum employment and price stability goals, and in that regard, we'll be prepared to adjust any of the details of our approach in light of economic and financial developments. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks. The committee is determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Nick Timmeros of the Wall Street Journal. Chair Powell, the unemployment rate at 3.6% in March is now essentially at the level that the committee had expected would prevail over the next 3 years, and at the bottom end of FOMC participants' projections for the longer run rate that you submitted in the projections at the last meeting. How has your outlook for further declines in the unemployment rate changed since March? what does this imply for your inflation forecast? And how has your level of confidence changed with regard to the feasibility of slowing hiring without pushing the economy into recession? Thanks.
Thank you. You're right. 3.6% unemployment is just about as low as it's been in 50 years. And I would say that I expect, and committee members generally expect, that we'll get some additional participation. So people will be coming back into the labor force. We've seen that, particularly among prime age people. And that will, of course, tend to hold the unemployment rate up a little bit. I would also expect, though, that job creation will slow. Job creation has been at more than 500,000 per month in recent months, very, very strong, particularly for this stage of the economy. And so we think with fiscal policy less supportive, with monetary policy less supportive, we think that job creation will slow as well. So it is certainly possible that the unemployment would go down further. So I would expect those to be relatively limited because of the additional supply and also just the slowing in job creation. Implications for inflation, really the wages matter a fair amount for companies, particularly in the service sector. Wages are running high, the highest they've run in quite some time. And they are one good example of, or good illustration really, of how tight the labor market really is. The fact that wages are running at the highest level in many decades. And that's because of an imbalance between supply and demand in the labor market. So we think through our policies, through further healing in the labor market, higher rates, for example, of vacancy filling and things like that, and more people coming back in, we like to think that supply and demand will come back into balance, and that therefore wage inflation will moderate to still high levels of wage increases, but ones that are more consistent with 2% inflation. That's our expectation. Your third question was
your level of confidence that you can slow hiring without pushing the economy into a downturn.
So I guess I would say it this way. There's a path. There's a path by which we would be able to have demand moderate in the labor market and therefore have vacancies come down without unemployment going up, because vacancies are at such an extraordinarily high level. They're 1.9 vacancies for every unemployed person, 11.5 million vacancies, 6 million unemployed people. So, and we haven't been in that place on the vacancy, sort of the vacancy unemployed curve, the Beveridge curve. We haven't been at that sort of level of a ratio in the modern era. So in principle, it seems as though by moderating demand, we could see vacancies come down, and as a result, and they could come down fairly significantly, and I think put supply and demand at least closer together than they are, and that would give us a chance to have get inflation down, get wages down, and get inflation down without having to slow the economy and have a recession and have unemployment rise materially. So there's a path to that. Now, I would say I think we have a good chance to have a soft or softish landing or outcome, if you will, and I'll give you a couple of reasons for that. One is households and businesses are in very strong financial shape. You're looking at excess savings on balance sheets, excess in the sense that they're substantially larger than the prior trend. Businesses are in good financial shape. The labor market is, as I mentioned, very, very strong. And so it doesn't seem to be anywhere close to a downturn. It's therefore the economy is strong and is well positioned to handle tighter monetary policy. So, but I'll say, I do expect that this will be very challenging. It's not going to be easy. And it may well depend, of course, on events that are not under our control. But our job is to use our tools to try to achieve that outcome, and that's what we're going to do.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You talked about using 50 basis point rate hikes, or the possibility of them in coming meetings. Might there be something larger than 50? Is 75 or a percentage point possible? And if perhaps you could walk us through your calibration. Why one meeting should we expect a 50? Why something bigger? Why something smaller? What is the reasoning for the level of the amount of tightening? Thank you.
Sure. So 75 basis point increase is not something the committee is actively considering. what we are doing is we raised 50 basis points today. And we've said that, again, assuming that economic and financial conditions evolve in ways that are consistent with our expectations, there's a broad sense on the committee that additional 50 basis point increases should be on the table for the next couple of meetings. So we're going to make those decisions at the meetings, of course, and we'll be paying close attention to the incoming data and the evolving outlook, as well as the financial conditions. And finally, of course, we will be communicating to the public about what our expectations will be as they evolve. So the test is really just, as I laid it out, economic and financial conditions evolving broadly in line with expectations. And, I think expectations are that we'll start to see inflation, flattening out and not necessarily declining yet, but we'll see more evidence. We've seen some evidence that the core PCE inflation is perhaps either reaching a peak or flattening out. We'll want to know more than just some evidence. We want to really feel like we're making some progress there. But I mean, we're going to make these decisions, and there'll be a lot more information. I just think we want to see that information as we get there. It's a very difficult environment to try to give forward guidance 60, 90 days in advance. There are just so many things that can happen in the economy and around the world. So, we're leaving ourselves room to look at the data and make this decision as we get there.
I'm sorry, but if inflation is lower 1 month and the unemployment rate higher, would that be something that we would calibrate towards a lower increase in the funds rate? Or
I don't think 1 month is not enough. No, 1 month's reading doesn't tell us much. We want to see evidence that inflation is moving in a direction that gives us more comfort. As I said, we've got 2 months now where core inflation is a little lower, but we're not looking at that as a reason to take some comfort. I think we need to really see that our expectation is being fulfilled, that inflation, in fact, is under control and starting to come down. But it's not like we would stop. We would just go back to 25 basis point increases. It'll be a judgment call when these meetings arrive. But our expectation is if we see what we expect to see, then we would have 50 basis point increases on the table at the next 2 meetings.
Thank you. Colby Smith from the Financial Times. Given the expectation that inflation will remain well above the Fed's target at year end, what constitutes a neutral policy setting in terms of the Fed funds rate? And to what extent is it appropriate for policy to move beyond that level at some point this year?
So neutral. When we talk about the neutral rate, we're really talking about the rate that neither pushes economic activity higher nor slows it down. So it's a concept, really. It's not something we can identify with any precision. So we estimate it within broad bands of uncertainty. And the current estimates on the committee are sort of 2 to 3%. And also that's a longer run estimate. That's an estimate for an economy that's at full employment and 2% inflation. So really what we're doing is we're raising rates expeditiously to what we see as the broad range of plausible levels of neutral. But we know that there's not a bright line drawn on the road that tells us when we get there. So we're going to be looking at financial conditions, right? Our policy affects financial conditions, and financial conditions affect the economy. So we're going to be looking at the effect of our policy moves on financial conditions. Are they tightening appropriately? And then we're going to be looking at the effects on the economy. And we're going to be making a judgment about whether we've done enough to get us on a path to restore price stability. It's that. So if that path happens to evolve levels that are higher than estimates of neutral, then we will not hesitate to go to those levels. We won't. But again, there's a sort of false precision in the discussion that we as policymakers don't really feel. You're going to raise rates, and you're going to be kind of inquiring how that is affecting the economy through financial conditions. And of course, if higher rates are required, then we won't hesitate to deliver them.
Thanks, Chair Powell. Neil Irwin with Axios. Do you see evidence that inflationary psychology is changing, that in areas like workers' wage demands, businesses' willingness to raise prices? Do you see evidence that there is a psychological shift going on inflation? Thanks.
We don't really see strong evidence of that yet, but that does not in any way make us comfortable. I think if you look at short-term inflation expectations, they're quite elevated. And you can look at that and say, well, that's because people expect inflation to come down. And in fact, inflation expectations come down fairly sharply. Longer-term inflation expectations have been reasonably stable, but have moved up but only to levels where they were in 2014 by some measures. So you can look at that, and I think that's a fair description of the picture. But it's really about the risks. We don't see a wage price spiral. We see that companies have the ability to raise prices, and they're doing that, but there have been price shocks. So I just think it takes you back to the basic point was that we know we need to expeditiously move our policy rate up to ranges of more normal, neutral levels, and we need to look around and keep going if we don't see that financial conditions have tightened adequately or that the economy is behaving in ways that suggest that we're not where we need to be. So you don't see those things yet, but I would say there's no basis for feeling comfortable about that. It's a risk that we simply can't run that risk. We can't allow a wage price spiral to happen, and we can't allow inflation expectations to become unanchored. It's just something that we can't allow to happen, and so we'll look at it that way.
Gina. Great, thanks, Chair Powell. Gina Smilek with the New York Times. You mentioned in the statement both the upside risks to inflation from Russia and China. Obviously, those are very much supply shocks rather than demand side. And I wonder what you meant to convey by adding them. I wonder what you meant to convey by adding those.
Well, so our tools don't really work on supply shocks. Our tools work on demand. And to the extent we can't affect really oil prices or other commodity prices or food prices and things like that. So we can't affect those, but there's a job to do on demand, and that you can see that in the labor market where demand is substantially in excess of supply of workers, and you can see it in the product markets as well. But I guess I'm just pointing out that a couple of things for both the situation in Ukraine and the situation in China. They're likely to both add to headline inflation, and people are going to be suffering from that. You know, people almost suffer more from food and energy shocks but even though they don't actually tell us much about the future path.
You guys do not add that into the what?
Capable of
into the
preventing
CPI.
progress.
You know those are the biggest costs that Americans have as well.
And so
basically food and energy.
Making supply chains
and
temporary.
they annexed it away from the CPI
they're going to
make the number look much smaller,
the process
give people false hope on the economic side of things, especially Wall Street,
which is going to affect
criminal
inflation too.
crooks.
So they're in a way they're two further negative shocks that have hit really in the last 60 days, 90 days.
Victoria.
America's always been in the business of stealing taxpayers'
Victoria,
money.
we
Always.
Right?
Right?
I want to
Always.
follow up on that because you all have obviously highlighted that there are both supply and demand issues at play in inflation. And I'm just wondering, if these supply chain issues continue because of Russia, because of China, or just because these things take a while to work out, does getting back down to your 2% mandate require that these supply chain issues get resolved since you can only handle the demand side, as you said, or will you have to crimp demand maybe even further if the supply chain issues don't resolve themselves in order to try to get inflation back down to where you want it to be?
So, I'll just say for now, we're focused on doing the job we need to do on demand, and there's plenty to be done there. Again, if you look at it, it's essentially almost 2 to 1 job vacancies to unemployed people. There's a lot of excess demand. There are more than 5 million more employed plus job openings than there are the size of the labor force. So there's an imbalance there that we have to do our work on. It's a very difficult situation if you can't, you would look at core inflation, which wouldn't include the commodity price shocks, and that's one of the reasons we would tend to focus on that, because we can have more of an effect on that. But it would be a very difficult situation. I mean, we have to be sure that inflation expectations remain anchored, and that's part of our job too. So we'd be watching that carefully, and that it puts any central bank in a very difficult situation.
Howard Stein with Reuters, and thanks, and nice to be back. So the two questions, one quick one. You cited the 1.9 to 1 figure so often now. I got to ask you, what would be a good figure there? What would you like to see that come down to think that you're at sort of a non-inflationary vacancy to unemployed rate? And secondly, on help from inflation, how much are you counting on wealth effects through stock market channels? Equity markets broadly down quite a bit since late fall, first of the year. How are you mapping that into household consumption? Have they come down enough? Do you need another leg down in equity values to think that households are going to stop spending at the rate you need them to stop spending?
Okay, so in terms of the vacancies to unemployment ratio, we don't have a goal in mind. There's no specific number that we're saying we've got to get to that. It's really, you've got to get to a place where the labor market appears to be more in balance. And that depends not only on the level of those things, it depends on how well the matching function in the labor markets are working, because the longer these expansions go on, you can get very efficient with all of that, and the Beveridge curve shifts out, and that also tends to help. So there isn't a specific number. I will say we were at, I think when we got to 1-to-1 in the late teens, we thought that was a pretty good number. But again, we're not shooting for any particular number. What we'd like to see is progress, but we're not really looking at that. That's an intermediate variable. We're looking at wages, and we're looking at ultimately inflation. So that there are a bunch of channels through which policy works. You can think of it as interest-sensitive spending, and then you can think of another big one as asset values broadly. And there are big models with a lot of different channels that are related to that. We don't focus on any one market, the equity market or the housing market, or we focus on financial conditions broadly. So we wouldn't be targeting any one market, as you suggest, for going up or down, or taking a view on whether it's at a good level or a bad level. We just would be looking at very broad measures of financial conditions, of all the different financial conditions indexes, for example, which include equity, but they also include debt and many other things, credit spreads, things like that too.
Hi, Chair Powell. Rachel Siegel here from the Washington Post. To follow up from your message from the very beginning, what is your message to the American people about when they will start to feel the effects of, say, the 50 basis point rate hikes or multiple hikes? How do you explain to them what that does to their grocery bill or their rent or their gas bill? Thank you.
So the first thing to say is that we understand, and some of us are old enough to have lived through high inflation, and many aren't, but it's very unpleasant. It's just something people don't, when they experience it for the first time. You're paying more for the same thing. If you're a normal economic person, then you're probably don't have that much extra, to spend, and it's immediately hitting your spending on groceries, on gasoline, on energy and things like that. So we understand the pain involved. So how do you get out of that? And it's our job to make sure that inflation of that unpleasant high nature doesn't get entrenched in the economy. That's what we're here for. One of the main things we're here for, perhaps the most fundamental thing we're here for. And the way we do that is we try to get supply and demand back in sync with each other, back in balance, so that the economy is under less stress and inflation will go down. Now, the process of getting there involves higher rates, so higher mortgage rates, higher borrowing rates, and things like that. So it's not going to be pleasant either. But in the end, everyone is better off. Everyone, particularly people on fixed incomes at the lower part of the income distribution, are better off with stable prices. And so we need to do everything we can to restore stable prices. We'll do it as quickly and effectively as we can. We think we have a good chance to do it without a significant increase in unemployment or really sharp slowdown. But ultimately, we think about the medium and longer term, and everyone will be better off if we can get this job done. The sooner, the better.
Thank you, Jeff. Edward Lawrence with the Fox Business Network. So you've talked in the past about consumer spending and how that's driving to the economy. Are you concerned with this high level of inflation that the consumer will stop spending, pushing us into, and what's the level of your concern, pushing us into a recession?
So the economy is doing fairly well. We expect growth to be solid this year, and we see household spending and business investment as fairly strong, even in the first quarter, which was relatively slow on some other fronts. So, and the labor market, you look at the labor market, for people who are out of work and looking, there are lots of job opportunities. For wages are moving up at rates that haven't been seen in quite a long time. So it's a good time to be a worker looking to either change jobs or get a wage increase in your current job. So it's a strong economy, and nothing about it suggests that it's close to or vulnerable to a recession. Now, of course, given events around the world and fading fiscal policy effects and higher rates, you could see some slower economic activity. Certainly, it will not be. Last year was an extraordinarily strong growth year as we recovered from the pandemic. As I mentioned, growth over 5%. But most forecasters have growth this year at a solid pace, above 2%.
But we've talked with economists who have advised Democrats and Republican presidents who both said that the Fed is so far behind the curve on inflation that a recession is inevitable.
So, and as I said, I think we have a good chance to restore price stability without a recession, without a severe downturn, and without materially higher unemployment. And I mentioned the reasons for that. So I see a strong economy now. I see a very strong labor market, for example. Businesses can't find the people to hire. They can't find them. So typically in a recession, you would have unemployment. Now you have surplus demand. So there should be room, in principle, to reduce that surplus demand without putting people out of work. The issue will come that we don't have precision surgical tools. We have essentially interest rates, the balance sheet, and forward guidance, and they're famously blunt tools. They're not capable of surgical precision. So I would agree. No one thinks this will be easy. No one thinks it's straightforward, but there's certainly a plausible path to this, and I do think we've got a good chance to do that. And our job is not to rate the chances; it is to try to achieve it. So that's what we're doing. There are a range of opinions, though, and that's only appropriate.
Thanks, Steve Dorsey, CBS. You mentioned earlier just now fading fiscal policy. Do you feel that the Fed has been supported enough from policies at the White House and in Congress in combating inflation?
It's really the Fed that has responsibility for price stability, and we take whatever arrives at the Fed in terms of fiscal activity. We take it as a given, and we don't evaluate it. We don't. It's not our job, really. We don't have an oversight function there, and we look at it as our job to given all the factors that are happening, to try to sustain maximum employment and price stability. So, if the Congress or the administration has ways to help with inflation, I would encourage that, but I'm not going to get into making recommendations or anything like that. It's really not our role. We need to stay in our lane and do our job. When we get inflation back under control, then maybe I can, give other people advice. Right now, we need to focus on doing our job, and I'll stick to that. Stick in our lane.
Steve Matthews with Bloomberg News. A number of your colleagues have said that rates will need to go above neutral into a restrictive territory to bring down inflation. One, do you agree with that? And two, you recently spoke in great praise of Paul Volcker, who had the quick courage to bring inflation down with recessions in the 1980s. And while it's certainly not your desire, and soft landing is the big hope of everyone, would this FOMC have the courage to endure recessions to bring inflation down if that were the only way necessary?
So I think it's certainly possible that we'll need to move policy to levels that we see as restrictive as opposed to just neutral. We can't know that today. That decision's not in front of us today. If we do conclude that we need to do that, then we won't hesitate to do it. I'll say again, there's no bright line, that you're stepping over. You're really looking at what our policy stance is and what the market is forecasting for it. You're looking at financial conditions and how that's affecting the economy and making a judgment. We won't be arguing about whose model of the neutral rate is better than the other one. It's much more about a practical application of our policy tools. And we're absolutely prepared to do that. It wouldn't hesitate if that's what it's taking. So I am, of course, who isn't an admirer of Paul Volcker? I shouldn't be singled out in this respect, but I knew him just a little bit and have tremendous admiration for him. And I would phrase it this way: he had the courage to do what he thought was the right thing. That's what it was.
Do not.
It wasn't that
and that's
it
the
wasn't
problem.
a particular thing.
Because you're a Wall Street banker.
He always did what he
and
thought
he
was
was
the right
more
thing.
of a
Read his
pragmatic,
last autobiography. That really comes through.
globalist economist that had Main Street in mind more so than Wall Street.
Thing.
That's the difference.
We do see
and everyone knows this.
Restoring price stability.
You cannot put Wall Street types in economic places
in coming years.
Think they're going to think about Main
without
Street.
Price stability,
it doesn't work.
The economy doesn't work for anybody.
Secretary of Treasury, federal chairs, these people should
really
not be holding offices or places
if you look at the last
in the
cycle,
Wall Street market bias.
We had a very longest
taking care of Main Street
cycle.
It's the greatest hustle of all time.
History.
It's the greatest
in
hustle.
the last 2-3 years,
like everyone knows this.
Of
It's not
this
even
tight
a
labor
secret.
market
It's
going
funny.
to people in the lower quartiles, and it was racial wealth and income, not wealth, but income gaps were coming down.
Oh man, give it a rest.
It's a really great thing. We'd all love to get back to that place, but to get back to anything like that place, you need price stability. So we've been hit by historically large inflationary shocks since the pandemic.
Wall Street.
This isn't anything like regular business. This is we have a pandemic. We have the highest unemployment, since the Depression. Then we have this outsized response from fiscal policy and monetary policy. Then we have inflation. Then we have a war in Ukraine, which is cutting the commodity, patch in half. And now we have these shutdowns in China. So it's been a series of inflationary shocks that are really different from anything people have seen in 40 years. So we have to look through that and look at the economy that's coming out the other side. And we need to somehow find price stability out of this. And it's obviously going to be very challenging, I think, because you do have, numerous supply shocks, which are famously difficult to deal with.
And they're about to get worse. And they're going to get worse. That's what they're not talking about. China is still on lockdown. Every day you're talking about billions of dollars being lost.
Earlier, you just said that if necessary, I think were the words that you would, or if it turned out to be necessary, or you said it's possible that we'll need to move policy to restrictive levels, given where inflation is and the hot economy is, or certainly the hot labor market as you described it. Why still the hesitation? I mean, shouldn't it be, what else do you need to see in order to determine that?
Exactly, over our order, 100%.
At this point. Thank you.
It's always been robbing Peter to pay Paul.
We're not
and when you rob him, you instantly point to a bystander that witnessed it and try to tell the people the truth. No, he did it. I just saw you do it.
Continue to do so.
Again, that's always been the nature of this country.
We can't make that decision.
Especially since moving up the gold standard.
About how high to go.
Giving so much credence and power to the printing press of the Federal Reserve
when we reach neutral.
Basically, deputizing them the ability to have control over your wealth.
As I mentioned. So it's
through
not
the value of,
we don't want to make
increasing the money velocity aspects of M1, M2, and 3 values.
Again,
and leveling the ideal of what rate hikes will look like in an ideal stock market. Not Main Street growth, but the stock market. Every piece of data shows this. Hence, that's what I was telling the guys yesterday.
Radio. The balance sheet.
Again, markets have
did you
memory.
decide to wait until June 1st?
Every time the
to
Feds
begin
came out and spoke on a very,
securities roll off
damning
and
piece of evidence against the
middle
market,
of this month, say,
it always found a way to rally. Right? It finds a way to rally
for
on,
monetary
again, indicting the ham sandwich. That's a buy.
And then finally, I'm just
They
curious
gotta have a way to,
why you felt the
kick
need
the can down the road. It's a stay of
address the American
execution.
people at the top of your remarks. Are you concerned about
Today,
the credibility with the
definitely a
American
stay of execution.
So why June 1? It was just pick a date, and that.
That's why I always trade,
the date that we picked.
after the fact on days like this because I know their energy.
It's not going to have any macroeconomic.
Wall Street had taken L's.
We just picked that.
A degree in the punch bowl of a 40-year bull market. Most recently of what, 14-year
I would
bull
read
market since
into it.
2008,
In
whatever.
terms of the effect, I mean,
2013,
I would
whatever, 13
just
years,
stress
whatever,
how uncertain
is
the effect
indicative of
is
people who
of
cannot, let
shrinking the
go
balance sheet.
of a punch bowl or a party, a never-ending party,
We run these models and everyone does.
where you
in
can
this-
have
in
a
this
natural
field
reset,
and
get
make
the market
estimates
back in
of what
order,
will
get
be
employment,
how-
the type of
how
jobs
you
that really
measure,
push great
you know,
quality
a
of life,
certain
a
quantum
qualitative way of life for
balance sheet
everybody,
shrinkage compared
improve your
to
infrastructure,
quantitative
improve
easing. And
bringing
these
jobs
are very
truly back,
uncertain. I really can't be any clearer. There won't
opening
be
the
any
door more
other,
so for small
people
business to really
estimate
grow.
that,
And those things are a pipe
broadly on the
dream.
path we're on, and this is
America knows
this
it's
will
at the
take
end of its,
probably too seriously, but sort of
it's
one
propaganda
4%,
campaigns, if you
one
will.
rate
Hence,
increase
that's what
over the
it,
course
I'll
of the
speak
year
about
at
it when
this
I go
pace.
live. I'll just
But
wait.
I would just say with very wide
Let's
uncertainty.
let them keep lying for a little while longer, and then we'll come in and add our
They're
sauce.
much smaller than that, by the way, and some of you may have read about that. That's kind of a mainstream estimate. We know that it is part of returning to more normal, more neutral financial conditions. And our strategy is to set up a plan and have it operate, and really have
That's literally macro right now. 3% raise,
interest rate be the
inflation's
actual
at
tool of monetary
10%.
policy.
Literally about
In terms of
17%,
speaking
but
to the American
we'll let them
people,
lie.
so I feel like sometimes I want to remind us really that that's who we work for, and that it's inflation that people are feeling all over the country, and it's very important that they know that we know how painful it is, and that we are working hard on fixing it. I thought it was very important to do that.
Lies.
And
I got to bring the lies back.
So that was really the thinking behind that.
Do you think the Fed has a credibility problem?
No, I don't.
Yes.
A good example of why it would be that.
Yes.
So in the fourth quarter of last year, as we started talking about tapering sooner and then raising rates this year, you saw financial markets reacting.
Yes.
Very
y'all were insider
appropriately,
trading
less any
on
particular
policy that y'all was
measure,
favoring.
but
Several of the federal governments
financial markets
and the vice chair was also insider trading. Yes.
Y'all
have a credibility problem.
Actions.
Yes.
Really amplifies our policy. I mean, it's
the lies.
Monetary policy is working through expectations now to a very large extent. We've only done 2 rate increases, but if you look at financial conditions, the 2 years is at 280 now. In September, I think it was at 20 basis points, and that's all through the economy. People are feeling those higher rates already.
I know they buzzing.
And so that shows that the markets think that our forward guidance is credible. And I
lies. If that's the case, the market would not be up right now on literally 17% inflation. Stop lying. Like, you people are straight parasites, and we know it, and everyone knows it. Who follow
finance. To
this
expand
stuff
on Steve's
right
questions
itself,
about Paul
without
Volcker,
bias.
there was also a great pain that came with that as well. Higher interest rates obviously affecting households and businesses, and wondering how you kind of square what might be demand destruction. Are you already seeing that? Is the idea here to incentivize a lack of spending, to decrease consumption, to perhaps table business investments? Is that essentially what's happening through this hiking cycle? Thanks.
Well, no, you're not going to bring demand down
you can see
by lying.
places where
Inflation going to
demand
continually
is
persist
substantially in excess of supply,
because he
and what
has,
we're seeing as a result of
the
that is
courage
prices
to pull up
going
Paul Volcker
and at unsustainable
and to
levels
stop
that are not
this
consistent with
euphoria
2%
of people
and so
running up these assets.
what our tools do is
these
raise
prices
interest
and
rates,
stocks that have no
demand
organic growth,
moderates, and it moves
white
down.
paper or trajectory in
Interest
place.
rates,
They do not have a way to
businesses
fight this
will
stuff.
invest a little bit
They're
less,
giving
less
lower guidance.
persons will spend a little bit
And
less.
people still say,
That's
okay,
how it
well,
works.
I'll just buy,
But also
bad data
getting
in
supply and
relation
demand
to
back.
it'll just
Back in
dissipate a
balance
month from now.
is what
not
gives
gonna
us
happen.
2% inflation, which is what gives
Not gonna happen.
the economy a footing where people can lead successful economic lives and not worry about inflation.
Like lies.
I mean, yes, there may be some pain associated with getting back to that, but the big pain is in not dealing over time, is in not dealing with inflation and allowing it to become entrenched.
Thank you, Chair Powell. Greg Robb from MarketWatch. I was wondering if you could take a step back and talk about, in March, the dot plot had, looked like steady quarter-point rate hikes, get the funds rate up to 2% at the end of the year. Now, it seems like you're much more aggressive. So could you talk about the thinking that's behind that? Thank you.
So I think what you've seen is really, I would say, last fall, in the middle of last fall, there was a time when our policy stance was still pretty much in sync with what the data were saying. If you remember, there were a couple of weak jobs reports, and inflation had actually come, month by month, inflation had come down till September, a few months in a row, stayed low. And then around the end of October, we got three or four really strong readings that just said, no, this is a much stronger economy. And by the way, then with the restatement of the jobs numbers, it looked like the job market was much more even and stronger in the second half of the year, but that hadn't happened yet. Anyway, we got an ECI reading, Employment Compensation Index reading, the Friday before the November meeting. Then we got a really strong jobs report. Then we got a really high CPI report. And so I think it became clear to the committee that we needed to adjust and adapt. And we have ever since then. Really, ever since then, we've been adapting. The committee moved by the time of the December meeting to a meeting of 3 rate increases, then to a meeting of 7 rate increases at the March meeting. And that process is going on, and it's clearly continuing. And that's why I say, and I actually mentioned this at the March meeting, that no one should look at any single SEP as sort of a real resting place for 90 days, because we're in a fast evolving situation, and that's what's happened. You can see unanimous vote today, of course, and
that's kind of consolation prize. Like these people are straight disconnected from reality. They're complete frauds. They obviously they're complete frauds.
By the way, other
I know I'm speaking to the crowd, I'm speaking to you guys, but
it's just us adapting to the data and to the situation.
That's why it's important that you guys can,
using our
be able to disseminate this stuff properly to your family, like your friends, those who are not necessarily initiated and understanding, the double talk
I want to ask how you're able to balance your dual mandate, stable prices, and maximum employment,
like super funny,
especially when the unemployment rate for Black workers is still roughly twice the rate.
We know this, but let's move on, because you're not going to tell the truth.
Unemployment rates for all racial groups have come down a lot and are now much closer to where they were before the pandemic hit. So
here it is. They can never speak specific to
the
that's
Black wealth say, and that's important. But the bigger point is this: I do not at this time see the two sides of the mandate as in tension. I don't, because you can see that the labor market is out of balance. You can see that there's a labor shortage. There aren't enough people to fill these job openings, and companies can't hire, and wages are moving up at levels that would not over time be consistent with 2% inflation over time. And of course, everyone loves to see wages go up, and it's a great thing, but you want them to go up at a sustainable level, because these wages are to some extent being eaten up by inflation. So what that really means is, to get the kind of labor market we really want to get.
He's feeling cocky right now, because he's sitting there watching the stock market go up on a bunch of lies.
In the lower
still
of the distribution.
The ideal behind the wealth gap,
and we've got to get back to price
has been exacerbated because of
a labor market where people's
excess of printing more money and pricing
and
people out of the market.
We can have a long expansion too. That's
where even jobs can have underhanded discriminatory progress, policies
40 years,
and not still, put people in key positions where they can have a wealth increase in their life. Again, that balance or that ratio is staggering.
That's the way I think of it.
That's why they have independent studies on this. ACLU and many others. They do these studies all the time. They tell people like, hey, watch, this is the problem.
Best thing for
and they still like, no, rising tide lift all boats.
To support really sustained period of strong labor market.
We know the deal.
Thanks very much.
All right, so let's get this party started, because I don't have much time. I got training today too. All right, that's the lies. That's the lies. All right, we're not gonna let them propagandize the rest of our earwaves with the rest of that. Even though if you want to listen, of course, cut on your computer tater and go indulge yourself. But yet and still, we are opportunists first. So by that token, we trade opportunity. We don't get caught up in the emotional cues when it comes to the marketplace, although we have strong opinions when it comes to the reality of nature, news, and also data, organic data. Everything that tells us that this market is, you know, literally on borrowed time. It's like the realization of a lifetime that we are watching these things go down in real time. Like, as soon as he stops talking, the market always want to pull back a little bit here. Go figure, right? Because again, we understand the nature of how the algos even work, the nature of how this is a mechanic market now, where they're just programmed to buy certain people speaking buzzwords, talking points of certain individuals. The extent of how this market is so robotic, hence, you know, giving credit and credence to Charlie Munger of you know, Berkshire Hathaway, of course, him and Warren Buffett, when they spoke at their shareholders meeting over the past weekend and spoke about how the markets are now somewhat a gambling parlor, right? It's a casino, literally on wheels, right? It's you know, it's the wild, wild west now. Why? Because the credibility of our economic situation has been exploited. It's been exposed. It's been pretty much the cover been, you know, lifted off of it. Hence, China knows this. China definitely knows this. Why? Because the extent of their lockdown dealing with COVID now is if, you know, it just hit their nation for the first time ever. Like, this is like, it's like, we know that's not the case. We know that the extent of them continuously keeping this lockdown at this level of the lockdown, you know, is also to spike the American perspective. Why? Because they're fighting a proxy war with Russia through value of Ukraine. We already know that. It's not even for a debate. We're not going to lie. We know that this is, you know, secretly how America and Europe is fighting Russia by donating weapons and money, right? Taxpayers' money to fight a failed state, right? Fight for a failed state to spite Russia. And the fact that China aligns himself with the idea that, okay, well, you know, we don't need you guys encroaching on other people's territory as well. Hence, if y'all saw the article today, China rips obviously into NATO, saying that, you know, of course, if you try to, you know, bring in, you know, what was that, Switzerland and what is it, Poland, a few other places into the NATO region, we're gonna have a big major problem with that. So even China's signing off about that. Yet they're continuously still trying to play dumb. Why? Because they are pushing. It's like, you know, you get a stick and you're poking the big proverbial bear. They're poking the proverbial bear right now. What is the proverbial bear? Well, the proverbial bear is that now that we are in this kind of new shakeup, if you will, right? Let me get my camera here popping. We're in this new proverbial shakeup now where people are reassessing or moving chess pieces around on the chessboard now in terms of their allies, right? In terms of, you know, who are they going to ride with, you know, going into the future, in a sense, with, you know, they're clicking up. The same way we're seeing this happening in the corporate world is also happening in the national value, right? The national arena, where you're starting to see countries link and click up with others. And you have others who are trying to play the neutral role because they know they can't afford to, you know, pick sides. Why? Because they benefit possibly from both, or they're being blackmailed by one side and have to accept the side of one that they typically wouldn't because of the situation. This is the nature of how you know, this stuff works. Again, a lot of people may be a little, you know, they may be a little indigent when it comes to understanding how to, you know, political science and warfare, all that stuff works. But nonetheless, it gives us no excuse to, again, just kind of side with anything people's trying to sell you, push you, when it comes to you having to be, you know, sovereign in your own right and taking care of your own business, right? Your own household. So these things are very important. Why? Because markets are also front loading the idea of, you know, what it will be like under these, you know, XYZ conditions. Now we know that's not, you know, nowhere near reality in terms of what it really deals with people that's on the ground in these particular enclaves of environments or these geopolitical areas, because they're the ones suffering from all this, right? They're the ones getting all the back blow from this. Again, you think about Europe right now. Europe is literally they're literally about to go into a energy crisis because of the whole issue with Russia. Either they're going to shut down oil going to the EU, or they're threatening to, you know, really put a ban on Russian oil when they know they have no other alternative. See, they don't have the rule of Tina. There is no other alternative for them, right? At this point, because we don't have enough, in our perspective, especially when it comes to SPR, strategic, you know, petroleum reserve on our side, and enough pumping out of the Gulf and whatever our little areas that we have within our little, areas of entry, the
Permian Basin, course, all those areas like that, the Adirondacks, whatever, that comes with natural gas to kind of ship that stuff to Europe. That's a logistical nightmare. We already know that. Like, you got to, number one, pump it. You got to get enough of it up. Number one, that it doesn't disturb the, you already, use case for your clientele in those regions. And you got to, again, ship it across the Atlantic, right? Dock it, then offload, all this stuff, somewhat in a repetitive fashion. Let's mind you, guys, they have to do that in a repetitive fashion to give natural gas literally to the entire, Eastern Europe or, Western Europe scenario. Like, that does not make sense in no form or fashion. In the sense of, something that's, doable on a consistent level where you can say that this is the way we're going to do business going forward. And you have no other, taps on deck to kind of compensate if one of your sources go down. That's another factor. Why am I bringing that up? Because energy prices, right? If you're thinking energy prices are going to just, roll over from here or go into a form of, degradation or abate the ideal of the inflation issue not being relevant and prevalent, then you're in for a rude awakening. That's not how this stuff works. As one would always say, and I always have said, once the inflation genie gets out the bottle, you cannot just put it back in there, right? You cannot just throw it back in there just because you so-called choose. Again, I can show you better than I can tell you, right? Why? Because if that was the case and they feel like they had a hand on this and their economic sanctions are really working, and the fact that they don't have any other issues to deal with on the economic side of things, right? It's just only strictly war and war only, then I can guarantee you a majority of these, these commodity prices that we speak about, that we go to look at to see where the organic readouts are kind of giving us a signal on what they are, what are they really saying? Those numbers would be coming down. They'll be coming down, right? Because it will be like, okay, well, yeah, it seems like they're going to get a hand of this stuff at some point. So it's no need for us to, continuously hide out in energy stocks, hide out in other places where, it's not necessarily a big issue right now because, we should be fine given the fact that, we have an idea that the war is going to end within, let's say the next month or so. That'll really damper that. And then we can start forward looking, right? Because that's what the markets do, right? Markets are forward thinking mechanism, right? They like to price new money in before it even come out the printing press or hit the ground off the back of some level of production data readout, right? So again, it's all based upon a lot of hopium, right? We know the markets now are literally trading on a lot of hopium. Essentially, that's all it is, guys. You can't make this stuff up. Again, it's no other way that I can kind of, explain it. Now I'm in explaining mode. He's explaining it again, folks. He's explaining. There's no other way I can explain this stuff beyond just that. Because if I ever give you guys a false sense of thinking that, okay, no, it's like this because of that, because it may help the thesis that one may have about the market, that would be irresponsible. All right. And I'm not going to do that. Why? Because if you're thinking that, we're out of the woods with this stuff, then that's a rude awakening, right? That's a rude awakening, just waiting to happen. And so we have to be cognizant of that. So again, let's take it to trial. Right? Exhibit A. Let's take that thing to trial, right? Take it to trial. What do you see on my screen right here is no more than what? Reality, right? This is the reality of things, right? This is as they say, this is the reality of things, right? You cannot escape these numbers here, right? Let me blow them up so that way you guys can see it. You can pull this stuff up yourself. But you cannot escape this. This is the real-time commodity prices. This is the Fed speaking, trying to tamper, or damper, I should say tamper, but put a clamp on the expectation that they're not still trying to be somewhat still a little accommodative to the market, but also try to fight inflation. Like, you cannot do both. You can't do both. We talked about this literally over a year ago when we was emphatically telling people, guys, get ready, inflation coming. Get ready, inflation is coming. Why? Because you cannot just continue to print money like that and you have no production to backstop that, right? That's like the debt to equity ratio just being completely skewed to to the debt side of the things, right? You're not going to win if you have more debt than equity. It's better to have more equity than debt, to be honest. But if you got more debt than equity, then you really up the creek without a paddle, right? You really up the creek without a paddle. So again, where's gold right now? It's running again. Okay. All right. These things should be coming down under the understanding that, the inflation hedge that we look at in terms of commodities, metals, energy, etc., utilities, some of, of the healthcare sector here and there, consumer staples here and there. Of course, you got to pick your poison. Those things will be true telltale signals of whether or not we are in a place where we can say, okay, well, we got a state of execution. At least we can say hands off from the equity market for now, and we'll be fine. Why? Because these things will be retreating a little bit. They will say, okay, well, yeah, you're right. Maybe inflation is not necessarily it's no longer, hitting a peak, and it's going to get ready to pull back here. And so we can start planning now to look at the economy, post, inflation starting to recede or, abate a little bit here. And now we can just focus on Russia. Gold is not telling you that right now, right? Copper, not telling you that right now. Platinum, palladium, right? Oil is not telling you that right now. Brent is still over $110 a barrel. Look at natural gas. We just talked about natural gas, right? Natural gas will be coming down because of, blah, blah, blah. Look what natural gas is doing. It's up near 7%, dang near. Like these are organic readouts, even though they can be manipulated. These things right now are calling bluff on the Fed's entire speech right now. Calling them bluff on it. Look at aluminum pricing, right? We just know Alcoa just got gutted. CNX, many of these kind of aluminum, bauxite, iron ore, all the different things like that, steels like that, took a backseat a little bit because they had kind of just ran over hot, right? Going into certain data, readouts themselves. So guess what? They took a pullback. Now they back to ripping again. Again, show me where inflation is abating here. I look at these numbers. I don't listen to what they say. I watch what they do. If Wall Street is any kind of signal of whether they're, truthful or honest about their perspective for outlooks, these assets still would not be ripping right now. They would not be ripping right now, right? I mean, food prices. We know food is literally a food shortage hitting the world in more ways you can imagine. We know wheat, the whole issue with wheat. Now, this is U.S. wheat. We know forget about it, right? They can't compete with Ukraine, Russia, and those areas that produce that level of wheat output in their areas. Wheat is still up. That means food prices are still more expensive. Rough rice up, corn is up. I mean, soybeans up, soybean oil is up. I mean, these are true reads. Cocoa down, okay, cocoa, okay, it's it's getting hot, right? We know the nickel trade is this. We're not going to even look at the nickel. Why? Because that's been a manipulated trade since we had this issue with the London Exchange. How they literally tried to kill the nickel prices from surging because that Chinese investor, who was one of the biggest nickel producers literally on the planet, they did that despite his balance sheet, right? His book value. Again, you couldn't make this stuff up. They play dirty games. Hence, guess what? China's repaying their favor now, but being on lockdown right now, hurting Greater Europe. Greater Europe definitely gets a lot of their products from China. Obviously, right? Alibaba, many of not even up for debate. This is the game that they're playing that most people don't understand when it comes to political science, right? And warfare, right? In terms of conflict. So you have to look a little deeper, right? If you are of the mindset of an investor who really likes to go, find that silver lining, that needle in the haystack, well, this is how you do it, right? You have to be privy to know where to look, how to look, right? And when to look, right? These things matter. Again, coffee still up, right? It could make this stuff up. Orange juice finally pulling back a little bit. We know that trade that's been all over the place. All right. Cattle down a little bit, not much at all. Look at it. 40 cents. Okay, that's enough to write home about. Lean hogs back up again. Right? They call lean hogs the new big tech, right? That's the new tech set, the lean hogs, all right? It's up, nearly about 3%. Feeder cattle up. Lumber pulling back a little bit. $33, 3%. Nothing to write home about. Why? Because the housing market is in flux right now. Right, but it's still over $1,000, right? $1,000 lot value, for a lot value of lumber. You couldn't make this stuff up. Again, this is also indicative of the house prices because the housing market is in trouble because the interest rates were starting to go up. Organically, you're starting to see those readouts go up on the Treasury. Them dog whistling to the market today to kind of appease them and feel as if, we may have a little stay of reprieve, right? A little reprieve, with the fact that, it's only 50 basis points. Well, we knew that. But the key or the kicker is what I noted to you guys in the back chat. What I told you guys, This is the silver lining. At the meeting that he did with the one girl from CNBC, and also the previous one he did when he was speaking to all these different economic forums, before they went into the quiet period before the FOMC, Jerome Powell spoke candidly about the idea of running off the balance sheet, right? Everybody been speaking about the balance sheet. Bullard, Daly, Mester, all of them, right? Bostic. You guys already know the Fed chairs, right? Everybody was speaking about the idea of what that looks like on the federal, level to run off that balance sheet. That $9 trillion worth of what? Fed money, printed money out of thin air, fake money, $9 trillion worth. So initially, Powell out of his own mouth, right? His double speaking mouth, right? He speak out of both sides, of course. 95 billion seems to be what? A fair value in terms of dealing with what? The runoff of the balance sheet. 60 billion is supposed to be in what? 60 billion is supposed to be for what? T-bills, right? Bonds. And the other what? 30 plus billion is supposed to be for what? Mortgage-backed securities. What did he do today? What did he do today? He literally almost cut it in half. Only 50 billion now, or not what did he say? 50 billion was it? How much he say? Like 30 billion? Or was it 50 billion? I got to go back. 50 billion. 50 billion in terms of that of what? Mortgage-backed securities. No, yeah, the T-bills, T-bills, right? T-bills. And that of what? The 25 billion, I think, for that of what? For mortgage-backed securities. So roughly around about 60 billion, somewhere around that 60, $55 billion, as opposed to that full 95 billion that they spoke about initially. Y'all know what that is, right? That's them kicking that can down the road in terms of what? Keeping that extra little bit of liquidity out there just a little longer. Of course, they weren't going to do everything. We knew that they was going to pull a what? We knew they was going to pull a hustle move. It was just almost evident. You're not going to take a 50 basis point hike and do a 95 billion runoff. That $95 billion runoff on the balance sheet will be equivalent to that of basically about, let's say, a third, quarter basis point of a rate hike in itself. Just from the nature of the liquidity that it would drain from the equity markets, that will also signal that, you don't have this, I'm gonna call it what it is, this wealth effect for the stock market, to stay risk on, through it all. And then, we'll be back to where we were, literally before, we kicked off this whole ideal of this tour or this Coachella of rate hikes coming down the pipeline. Now, the idea of them kind of kicking the can down the road when it came to the 75-point rate hike, well, we know that was going to be an outlier anyway. Now, Wall Street would say, well, we're pricing that in already. That's the excuse, right? They're going to say we were pricing 75 bips in. But how can you price in 75 bips when the man came out and emphatically said, ball intents and purposes, we're definitely going to do 50. Right? Again, they're going to front run the average investor who's constantly trying to say that, the sky's falling. Of course it is, but they're never going to make it look that way. Why? Because they have to paint this picture that everything is what? Rosy. Again, gold is up, still going up. While we're talking here, gold is not retreating. Oil is not retreating. These numbers here don't lie, right? Everything you hear from the Feds is just that, word salad. These numbers don't lie. This is what I tell you guys. If you really want to get a readout on inflation, you come to the commodity tab. Go to whatever broker you use, platform you use, go to the commodity tab, check those numbers. I repeat, check those numbers. Because again, they can tell you anything on CNBC, Bloomberg, Yahoo Finance, wherever you go to get your news, they can tell you anything. But if you're not savvy and understand how to really read the true the numbers, the true tea leaves, then yeah, you'll be sold a bad bill of goods, as one would say. So again, this is the market you're going to deal with here. Going forward, now you have to fight the idea of what? The levels. Now we have to get playing the game of levels again. So we had a massive pullback into the 406 region. Now we're back, right? Now we're back. See, we're back. More, right? We're back. Now let's go over here real quick. Let's take this thing to trial real quick. I only got about another 15 minutes. I got to get out of here. I got training coming up. Right? I've been on the clock like crazy lately. But let's go there real quick. Right? Let's go over here really quick here. 1 second. Let's go over here. Let's go here. Let's go here. Where are we right now? So we're up near 3% on the day. We're up more than that, because if you think about the complete lows, we came down and hit a low. Basically, we was at around about 414. We actually hit 413.85, somewhere around that, the low today. Now we're all the way up here to 428, 42, and still heading higher. You see what they did here? So this is why I say you got to always be conscious about knowing how to put levels on the market. Why? Because if you ever just play the psychological trade alone without actually adding in the idea of the technicals too, in environments like this, because these type of environments are very misleading, because you would say, well, you would think that these people will do the right thing, right? They will do right by the markets, and allow the organic data to really speak for the market in a way where you can say, okay, given the nature of things, the market should be pulling back, which that's what the Feds want. They actually want to kill the demand in the market. That's the whole idea of inflation fighting. You got to kill demand. That way your supply can catch up with the level of your demand. See, that's the problem. They know that people will still continue to pay the prices because they have no other alternative, and they're buying in advance, offering more organic batches to front run that deal. If it gets better down the road, then yeah, they want to be stocked up. This stuff is not rocket science. Again, Main Street people may not have a clue because they're caught in the rat race and listening to these politicians and TV all day. The media just painting this rosy picture, and it's not. See, that's why channels like this exist. That's why people like me exist. People like you guys exist, because you can still be risk on and play the opportunity side of the market, but you also could be truthful when it comes to understanding the true nature of the data. That's why channels like this exist. And well, that's just, usually like the world's falling. Okay, well, the world is definitely not completely falling, but it has definitely failed, right? And it's just jumping back up so quick that you're not necessarily seeing that it has fallen, because you cannot make a base case that we are in a blissful society on a global level where we can take the type of approach where we say, when people use the analogous Tina, right? There's no alternative. There is another alternative, guys. We know that there's another alternative. They just will never employ or deploy that alternative. Why? Because that gives everybody at least a fair share of equity discovery, if you will, if they ever was to open up that ideal of what it would look like to really move the wealth at least on an equal playing field to mostly everyone, like everybody. That's not going to happen, right? We know that's a pipe dream in itself. Why? Because they got to play off the somebody got to feed off the poor. Somebody got to feed a parasite off the indigent minded when it comes to economics, right? The not so savvy people, the people who don't understand how to follow data points critically. Why? Because they just buy everything the media tells them. They get caught up in trivial things. They rather go lose themselves in maybe binge watching whatever they do, or watching sports. People are not really geared towards learning how to really build out their own qualitative way of life, void of what their government puts out there for them to follow. And by very nature of that, they'll do just enough in their mind to play it safe. But you realize, do Wall Street play it safe? That's a question I'm gonna ask you guys right now. Do Wall Street play it safe with your investment money every day? With your retirement money every day? Do they play it safe, or are they always in a risk-on mindset when they know they shouldn't be? This is the question you got to ask yourself, because ultimately, the White House, they're getting a lot of their messaging or their cues from Wall Street, not you. Meaning I say you, meaning the average citizen or Main Street people. They're not getting their cues from those people. The only time they take it serious when most people start threatening them that they're going to pull their vote or hold their vote or abstain from their vote. That's when all of a sudden senators get serious. They want to do their job, and they try to go out there and put out some fake presser and get everybody excited, thinking that they're going to do something to really fight the nature of what's really happening. And then people get what they call these short-term euphoria moments. Then they go right back to being airheaded the next day. It's sad. Again, children can hold a longer attention span than most adults these days. I guarantee you that. Why? Because they're too busy trying to hide themselves away from the reality of things. And the idea of what this country could be if it was really truly about being about that life, well, it's pretty much obvious now that that's not going to happen. I mean, you have to have a lot of people that got to move out the way for that to happen, and it's just not going to happen, right? So now you got all these proxy issues that's concerning, the global side of things, supply chains, production levels. Now you got, the need for, where you've outsourced all your factory jobs overseas purposely at your own peril. And now all of a sudden, you would act like you're surprised at the fact that when other nations shut down their countries or their economy, you're appalled by that. But yet you outsource all your jobs away to these other places, shut down your factories inside your own borders, and now you can't produce nothing of really true quantity to backstop people when they act shady towards you because you outsource everything because you're greedy. You want to get the biggest bang of return of money for the coffers of the government as opposed to the Main Street citizen. And now you again act like this is some true revelation that people are actually against you. No, they're not against you. They're about building out their own situation. And they hold all the leverage. Why? Because they're the ones producing the manufacturing, the production. So it's not hard to realize what you're up against, guys. Everything else is just noise. And we, as the saying goes, kill the noise, right? We kill the noise by understanding that, guess what? We know we're going to get a happy-go-lucky lie every time a politician opens his or her mouth. If you are an investor or a trader, our biggest, mantra is that we what? Right? We follow the money. We follow the money. Even when we know it's, as ratchet as it could be, we still do what? Follow the money. What you see on the screen right now is no more than that. We're following the money. Why? Because Wall Street has, again, the mindset that what? If they can kick the can down the road, provide that steady of execution as long as they could or can, then it's game on. Why? Because who wants to be at the lows 406, 410 going into an FOMC meeting where they're going to raise rates? Obviously, they ain't doing as much as they should. Again, you're talking about we're now up only 75 bips. 75.75. Let me say it correctly. We're only 0.75 bips in interest rate hikes, and yet we still got inflation literally around 15, 16%. Wall Street is sitting there laughing at Main Street every single time these things happen. So again, markets have memory. The last few FOMC meetings that had to deal with these kind of things or having to really face the public or face the world, what did the market do? It rallied. What happened today? The market did what? It rallied. Now, I ask you guys, what is the market rallying on today? Anybody? Write down in the comment section, posting on Twitter, posting on Facebook if you're listening on those areas. Why is the market rallying on this news today? Put your best, defensive case, you up against, you take someone took you to trial, you put your best defensive trial, shoes and hat on. Why is the market rallying today? That's the question you need to ask yourself. If you are contrarian trading it right now, definitely, right? If you're trying to go against the trend right now, you got to ask yourself, why is the market rallying today? Because you know exactly the extent of what you're dealing with. You're dealing with people who have, exorbitant amounts of cash on hand. Now they'll say, well, I'm in dry powder. I'm sitting on a lot of cash. Well, did they get an all clear signal today that they can now deploy that cash back into the market? Okay, well, all they're doing is playing the what? They're just playing the pivots. They're playing the corners. It's better to be, again, off 406, 410, headed back up towards at least 430, producing that much of a what? To be honest, a lower high than it is trying to make a new lower low. That's steady of execution. Let's just see if we can get inflation down and we can have an excuse to be still hovering around some very ambiguous zones in the marketplace. Nothing new that we haven't already mapped out and planned for. Again, not that we have a more bearish tense than we have a bullish tense, but I can tell you organically, if you can give me a really good base case of why the market should be, in my opinion, in a very ultra bullish stance right now, then I can guarantee you that the majority of investors will be thinking just like you if that was the case, and we would already be back near 450, 440, at least by next week. Now, here's where it gets interesting, because you still got to get through the rest of the day, and you got to get through the futures market. If this is just, again, a steady of execution to get the market off the lows, of course, we hit oversold here on the 1 hour chart at least, literally going back on the 2nd of May, because it's just 2 days ago. 2 days ago, we were sitting at basically oversold on the RSI, which was very easy to buy that bottom, right? Again, we're not, that's why I say, you got to look at the market in every aspect. Don't get caught up in your feelings of thinking just because the data is what it is, that Wall Street is going to honor your bias. You got to follow the money, excuse me. You got to follow the market. You got to follow the technicals. You got to follow the fundamentals. Clearly, we hit an oversold there. I didn't fight that. We got the 406. We called that day. Y'all was right there. Many of you guys made thousands of dollars on that day. I literally called that entire market that day for everybody that follows our little environments. I called the market from the beginning to the end that day. Literally. And into the swing value of it too. Because we played off this pivot of what? 430. I was like, here we go. Here's our lower high, guys. Right? We getting ready to go back downtown. And we did. And then one day I just pretty much did a complete day of just calling out, where we going, guys. Here we go here. Okay, yep, we're going to break. We hit 410. We're going to pivot. We're going to stop. And then we're going low to 406. If we don't hold 406, we definitely go into 4,000. It held, bada bing, bada bung. We hit oversold on the RSI. No brainer, buy you some calls and nothing else. That's your hedge. You always got a hedge when the markets are seen to be what? Very, very what? Scary and skittish and fearful. When you hit key inflection points, key pivot points, you do not argue with the data at that point. You buy your protection and you move on. No more, no less than what we did. And the end result was just what? Great for those who took that, that understanding and made the move they needed to. So now we're running back to what? 430 pivot. Y'all see it right there. As a matter of fact, let me go ahead and move my little alert up here, because now that's the line in the sand. That is the line in the sand. The proverbial line in the sand is now back to 430, right? That's our line in the sand here. They have to obviously hit that pivot, close above it, and then you got to play towards that 2-day moving out, which is 432. Now, the 432, I can guarantee the 432 options right now are pinging. Probably for May 6th expiration, too. That 432 options call by, I can guarantee is pinging right now. All right? I'm almost certain that it's pinging. Let's go see real quick. Right? Let's run over here really quick. Let's go to bar chart, right? Let's take it to trial, right? Let's just say, let's take it to trial. Let's take it to trial, brother Emporium. Let's see what you're talking about, bro. You always be going in, bro. You be going in on this and that. Let's see if you really got a handle on this. Let's go see. Because right now my calls are up. Up on my calls now, 350%. I'm up 350% on my calls right now. I follow the money, right? We don't follow feelings, right? We know who we're dealing with. We know the actors that we're dealing with here, right? You're dealing with a marketplace that's just, disconnected from reality. We get that. Now, here we go. Let's go see if we get any kind of action at around the 430 and the 432 calls. Here's May 6th expiration. Matter of fact, that's the 4th, right? Because options expiring today, right? Which is interesting. That's what the market running to, right? Because a lot of put buyers start to cover, right? They start covering, obviously, right? And so that's causing the market to squeeze up a little bit, right? A little gamma squeeze here, right? Not necessarily the true nature of a gamma, but the ideal of it. So the 432s, the 430 and the 432 calls right now. The 430s, look at that, 40,000 contracts as of right now. As of the last minute, I just refreshed, 40,000. Notice you don't see anything else close to that number. You don't see anything else close to that number besides what the 425s when the market began to take off, probably there. But everybody was sitting at them 40,000. See, need I keep going on and on about this stuff? Need I keep going on and on about this stuff? It ain't hard to kind of follow the data, right? To read the numbers, to read the tea leaves, right? You know what to do, guys. It's not, right? The 432s, 12,000. About equal to almost the 431s. But again, we just saying that because it's 200-day moving average, right? This is on the 6th of expiring on Friday, essentially expiring on Friday. These guys are already up exorbitant amounts right now. Of course they are. They played the bottom of the market today, right? They up nicely here. 40,000 there, 12,000 here on the 432s. Now look even at the 435s, 20,000 contracts dang near on those. Look at the open interest on those, 19,000. That's significant. Why am I bringing that up? Well, look around it. Do you see anything close to that at around a $4 to $5 window? Well, the next one is around about what? 440, 21,000 contracts of those who bought. Those contracts were worth maybe what? $5 maybe, $3 or $4 maybe at the beginning of the day, if that. Maybe what? Yeah, about $2 or $3. A contract for the 440 when the market was down near 435, 413.85. Now they're up probably like about 25, 30, somewhere around there. Y'all do the math on that. All right, it's crazy, right? That's the extent of what happens when you get this reprieve, right? This idea that we're signaling all clear, but we're not in the all clear. We just got to front like we're in the all clear. So ultimately, you still stay conscious in what you're doing, but you also play by the rules of engagement. If it's risk on because people can't take those L's, you get right along in that lane, and you ride those wheels until until the wheels fall off. It's always going to be about following the money first. You follow the money first. You understand the nature of the data, but you follow the money first. Tech has more to lose. It was already at the $13,000 pivot level, that nexus, right? That crucible moment is if tech sitting at 13,000, of course, the QQQs, if it lose that emphatically and we go down there, because we down in the 12,000 range, they couldn't afford to allow that thing to just completely implode, because if tech goes, so goes the rest of the market. Like, everyone knows this. Like, seriously, everyone knows if tech goes, so goes the market. Because they feel like those are the only defensive plays that one would have to be in terms of being able to what? To still feel like they're gainfully employed in the stock market. So going forward, guys, y'all get it. You got to stay conscious about these things. No more, no less. We got an idea of what they're trying to convey with their messaging in terms of the Feds. They just bought themselves literally. They bought themselves literally about another month. They bought themselves another month to kick the can down the road. So guess what? The month of April could be very, very skittish. Excuse me, the month of May. The month of May could be very skittish. And this is typically what they call the May effect, right? Sell in May and go away. This is them bucking that trend. This is them bucking the trend. They have to. That's the sad part about it. They actually have to. Because they're too close to that 4,000 proverbial level or the 400 proverbial level on the SP 500, that if they know if they lose that, it is really going to get ugly. As the saying goes, too soon, bro, too soon. Right? But that's it. So I'll come back on. We'll do some more commentary on this stuff a little later. Y'all guys get it. It's still earnings season. The numbers have been up and down. We get it. It's Fed day, guys. It's Fed day.
Okay. Dick. إذا
Pay you by
Calm down before you stress up the groove. The energy a little different when the blessings accrue. Hey, who you talking to? Just know I ain't no regular fool. Could be anything in the world, but I can never be you. Because I stand tall like I'm on my tiptoes. Baby, you think a little too small. I got big goals, baby. Hey, where the money at? Look, I just need the info. Pronto, I go and get it and split it with my kinfolk daily. And I'm the type of that might change my number on you. Yeah, that's how you react when people took a slumber on you. Pretty brown skin, baby, I can see the summer on you. You see all the bread, and I know it make you wonder, don't you, don't you, don't you? I ain't surprised at all. Seen them rise and fall. Went up the mountain, it wasn't hard to climb at all. At the top, I found some relief. I finally got some peace. Carry on, but please don't mess up the mood. Yeah, I worked too hard for it. No, I need it, beat it, before you mess up the mood. Yeah, ooh, I worked too hard for it, and I need it, so please don't mess up the mood. Don't mess up the mood. Don't mess up the mood. Yeah, I worked too hard for it. Yeah, don't mess up the mood. Oh, it's so crucial, I gotta keep it. It's in the ass everywhere. No, it's not a secret, and I bet they didn't think that I'd ever get it. Everything you've done, I get it. The life you dreaming, I live it, and I'm coming in high. You better get out the kitchen. Yeah, I could make a hit on whatever you pitching. Baby, let me fill up whatever you missing. Or you like it up at the top, it's a better view, in it. I'm not surprised at all, no way. Hey, what you need, come on, just pay the fee, I supply it all. Went up the mountain and it wasn't hard to climb at all. At the top I found some relief, you see, so please don't mess up the mood. Yeah, I worked too hard for it, no, I need it, beat it, before you mess up the mood. Alright, ooh, I worked too hard for it, and I need it, so please don't mess up the mood. Don't mess up the mood. Don't mess up the mood. Yeah, oh come on, I worked too hard for it. Yeah, don't mess up the mood.
All right, guys, that's it, guys. I got to get out of here. I have a training session coming up here shortly. Hopefully we get a chance to go live again tomorrow, which would be great. So we can do somewhat of a recon on the market in terms of how we got through the future sessions this evening and until tomorrow's price action. We still have some great earnings coming up. Of course, y'all know we have Shopify coming down the pipeline. We have Twilio tonight. Many others got earnings coming up that are very, very, relevant assets to be looking at because of the inflationary environment. So we can kind of, mirror that with what the investment world may look like in certain sectors going forward. So we'll speak about those things again. Hopefully, tomorrow we get a chance to go live and we'll kind of, bring this entire day worth of price action to some kind of form of understanding when we hear pretty much all the excuses that come from out of Wall Street this evening. And we'll be able to deal with those things better. All right. With that being said, guys, enjoy the rest of your day. Peace, power, and profit to everybody. Thank you for coming through. Don't forget to like, share, subscribe on the way out the door. Hit the notification bell because when we go live, you want to be here. Why? Because we're going to keep speaking that unabridged, the economic truth of this stuff. Also, as stock market participants in a way where you won't be misled, right? So appreciate everybody. Thank y'all for tuning in, and we'll see you guys on the next one. Good day, everybody. Good day.